You are live, the software says to us. I'm here with Liam Cowley this morning, and we're going to chat to you a little bit about a couple of things which have really made a difference to our business. That is tax pooling and invoice factoring. Now, we're not accountants, and we put a lot of trust and value in accountants, and we obviously endorse our clients to do the same. So we're not experts on this. Go and see Richard Lockhart at Lockhart O'Shea, or Luke Kemis at Next Advisory, or Jonathan Gray down at PwC for tax pooling. But we wanted to disseminate more information about matters that aren't necessarily in our wheelhouse, so to speak, or our neighbourhood, but are of enormous value. So without further ado, I'm just going to quickly explain what tax pooling is, and then Liam's going to talk a little bit about invoice factoring, and then it'll be us for the morning. So tax pooling it's a confusing concept. And when Richard Lockhart at Lockhart O'Shea first explained it to me a few years ago, it was really a little bit intimidating, and I had to go and do my research. So essentially what it is, and it sounds like a real Ponzi scheme, and in a way it is. There's this legislation that was created some time ago, I think it was in the 90s, whereby the IRD allows the creation of intermediaries to hold provisional tax payments from taxpayers in a pooling account and offset payments that, say, if you have person A and person B, if person A has underpaid their provisional tax, as long as person B has overpaid, if we assume it's a two-person pool, as long as person B has overpaid their provisional tax, that intermediary can actually go back and apply the overpaid provisional tax as the underpaid person's provisional tax.
Right.
Now, the advantage of that is two things. Number one, you don't have to pay UOMI, use of money interest, and the interest rate which a tax intermediary like PwC or tax traders will give you is a lot sharper than the IRD late rate. So you save there. Also, peculiarly, is that even how you say that word?
I think you did it
I think
well.
I did it reasonably well. I got all the syllables out there. Peculiarly, maybe I went for it too many times there. I did. Unbelievably.
That's easier.
It's easier. You are actually allowed to pay almost a year and a half or a year and a quarter. And if any accountants out there are watching me, if I got that wrong, please correct me. Not my own accountant with my own stuff. That would put shivers down my spine. But you are actually allowed to pay almost a year after that actual tax period. So that in and of itself allows for massive advantages with regards to cash flow for businesses. There's also some other quite neat advantages of using the system. With tax traders who we use, you can either do it on a week by week, month by month basis, or you can make lump sums and go back. You can do it in advance, almost like, say, regularize it to even out that cash flow. And I've personally found it a wonderfully useful device for managing my cash flow, so I'm not hit with some massive unexpected tax bill. But yeah, go and get proper advice. We're not accountants, but it is something that I think a lot of people don't understand. Even like relatively sophisticated commercial clients of ours don't understand it or weren't even aware of it in a lot of cases. So yeah, we thought we'd get that one out there today. So Liam, you're going to talk a little bit about invoice factoring, what it is, and maybe a word of caution around, and given we've been working on a few matters lately regarding invoice factoring.
Yeah. So we've seen a couple of these agreements come our way from our clients, and I've been lucky enough, or had the misfortune, however you see it, to have a look over them. And yeah, they can be quite knotty agreements depending on who it's with, but they do obviously have a utility. And broadly, that's essentially you have a series of invoices, and it's usually best for, say, it'd be preferable if you had your invoices paid every 30 days and you had quite a lot of clients which only paid out every 60 days or something like that. So an easy way to almost basically release the cash of those invoices is you go to this invoice factor, ROR, and they they release, or they basically buy the invoice off you for, say, 60 or 70% of the face value of the invoice, and then they in effect chase that debt. And then they chase it, and then once they get paid from that, they'll usually take their fee and disperse the funds back to you. But as anything, there is the difficulties, there's fees in there, and there are different, sometimes fish hooks. As I said, I've seen a few agreements where there's the money that they're paying back to you, there's actually a sort of hidden fees where there's actually starting to be a retention account for if they start having to really chase for these people. But it's mainly, the best way to use these things is for clients that you know that will be paid, or sorry, that will actually be able to pay those invoices, because I said there are all those fees, and if you start sort of handing over these somewhat dubious invoices for clients, it's just going to probably start blowing up in your face, to put it in a pretty simple term.
Under the agreements that we've been dealing with, the buck does still stop with you.
Yeah, exactly. And you don't really want to just almost double your problem by, say you do have a cash flow problem, and that's why you're using the invoice factoring system. You don't want to then have to almost buy that back, but then start having to pay for sort of almost penalty fees because this invoice factorer hasn't been paid themselves. And I mean, that's how they make money. They're a business, they're in to make money. So you don't want to almost have now two debts outstanding to two different parties.
Yeah.
But as I said, it's not all doom and gloom. There is utility to them. And I mean, it's better to, well, it's easier maybe to invoice factor than to go to a bank, for example. There's no, and you might not need to do providing sort of like real estate security or something like that, or because it's in a way the debts themselves are the collateral. So there's lots of utility there.
And just to really, yeah, thanks, Liam. That was awesome. Just to really hammer it home, the key point of Liam's little soliloquy there, another challenging one for this time in the morning without enough coffee.
You're pushing yourself.
Really pushing myself. So just to really ram home the key point, if you've got a client, a big institutional client with a big balance sheet, and you know that other than some black swan event, which of course we've just had, that they will pay you, but they are very strict with 60 or 90 even day payment terms, you use this device to ensure that you have a shorter pay cycle, or to create the effect of a shorter pay cycle, but you don't have any real life concern, or a concern in real terms that you're going to be left holding the bag, so to speak, by this large but perhaps what's the word? Say immobile, but unbending institution who's not going to bend for you, because they're
just the bargaining power is different.
They're a big institution. They're not going to say, "Yes, sure, Mr. Watts down at Watts Plumbing, we give everybody else in New Zealand 90 days, but we'll pay you in 4."
Yeah,
it's just not going to happen. But there is a distinct difference between that and some turkey that you've dealt with once. You go off to one of these companies and try and use his invoice as the collateral.
Yeah.
Well, you might be
wily kind of.
Exactly. So in a sense, you're borrowing from Peter to pay Paul, but then you end up having to pay Peter back, and then pay Peter fees, and then Peter end up causing you more problems.
The whole palaver,
more problems than Paul in the end. But they're cool. Both of them, tax pooling and invoice factoring, are cool human creations. Perhaps a little bit sort of complicated at times, but used and understood properly can offer significant value.
Yeah,
and go and get expert advice from some of those cronies of ours that we just gave a bit of a pump up to. All right, have a great day. Cheers.
Awesome. Cheers, guys.